Gentlemen, I hope you enjoyed your lunch and had enough time to perhaps chat to colleagues new or old. Let me quickly explain how this afternoon's going to work. We have a keynote address now on MIFID II. Then at 2:30 you have another choice to make. Either stay in this room for more on MIFID, a big panel discussion which will take us up to the coffee break at 3:45, or at 2:30 after the next speech you can decide to go to the other auditorium on the other side where it's all stock pickers. So there's 3 different presentations on the year of Amazon, US healthcare, and defence and industrial policy. So no choice to be made for the next half hour, but just be aware at 2:30 we'll be playing musical chairs again. So let me introduce our next speaker. We're delighted to have him here from the Financial Conduct Authority, telling us about independent investment research in MIFID II. Please give a warm welcome to Adam Regglesworth. Adam, thank you.
Well, it's finally here, after 7 years in the making, about a decade after the financial crisis. The Markets in Financial Instruments Directive 2 has gone live and it's in force. And despite the wide range of predictions about the initial transition, in most areas it seems to have gone relatively smoothly 2 months in. Today I'll set the scene for this afternoon's sessions. I'll start by briefly recapping the MIFID II reforms on inducements and research, and then turn to why these matter to all of us here in this room. I'll then cover a few more specific areas. First, I'll discuss what these changes mean for you as independent research providers. Second, I'll turn to the issue of research pricing, and then finally I'll make a few comments about corporate access. Before turning to these points, I'll begin by briefly setting the scene. When I spoke here 2 years ago, or in a different venue, but at this event, we were still awaiting the European Commission's delegated directive, which would set out the EU-wide reforms in this area. And 2 years on, those reforms are now in place. And as I said before, the initial stages suggest a smooth transition, but also that some fundamental shifts are happening in market behaviour and practices. So I'll start with a brief recap on what MIFID II set out to achieve in this area and the actual changes it has made. One overarching principle of the MIFID II reforms was to ensure that portfolio managers act as good agents in the best interest of their clients. It aims to enhance investor protection by preventing asset managers from receiving valuable third-party benefits that could influence their behaviour in a way that may be detrimental to clients. In tandem, MIFID II also seeks to improve transparency, reduce conflicts of interest, and promote competition by requiring brokers to unbundle their services. So what does MIFID II now require in detail? Well, for asset managers, there's 2 choices. External research must either be paid from their own resources, or P&L, or they can be paid through a research payment account if they plan to pass the costs on directly to clients. The RPA has a number of other requirements attached, such as requiring upfront budgeting and disclosure to clients of the costs, and then subsequent accountability over what research is purchased and how it has benefited those clients. For sell-side brokers, execution services must be separately priced from research or other services, and they cannot seek to induce business by offering free services and benefits or heavily reduced pricing. So the question is, why should any of us care about these changes? Well, first and foremost, these reforms should ensure consumers get the best value for money from the asset managers who are looking after their assets. That means you and me, and millions of other people with pensions and savings. It also means ensuring that the previous estimated amount spent through dealing commission on research, upwards of £1 billion a year in the UK, is applied as efficiently and effectively as possible. Spending should not be wasted on low-value or duplicative activities and research, but should instead be directed towards services that genuinely add value and improve investment decisions. And to the extent that some previous costs were not justified, or firms fund research themselves, this would also bring a direct saving to consumers. But I think critically these reforms offer an opportunity to everyone here. For those portfolio managers among you, It brings the opportunity to more easily identify and source the research from the best providers at the best price to help you make better investment decisions for your clients. It also allows you to demonstrate that both your investment and execution decisions are free from conflicts and inducements risks. And for the many of you who are independent research providers here today, it should level the playing field and give you the opportunity to compete more effectively based on the price and quality of the research that you deliver in a more transparent marketplace. The reforms also promise to place a new premium on differentiation and specialisation of research. And I think that many of you here are well placed to exploit that. For the sell-side brokers, it brings the opportunity to identify which research services actually add value and can generate dedicated revenues versus those which do not. And for those of you representing the new research platforms and compliance solutions, it's an opportunity to offer new innovative solutions harnessing technology to improve the distribution, pricing and payments for research. Alongside these opportunities, there are also other benefits that we see as a regulator. As research no longer influences the decision over which brokers are chosen for execution, we'd expect the buy-side firms to place a keener focus on execution quality and cost in placing orders. It leaves the trading desk free to focus on what they do best. And meanwhile, brokers on the sell side, in their execution capacity, we judge purely on that capability. To the extent this results in improvements in best execution, again, this could result in improved returns for savers. So what have we seen so far, 2 months in? Well, there's clearly been an overwhelming move among asset managers to go to P&L payments for research, and a general reassessment of their needs and the best suppliers to meet those needs. And there's been a strong debate in the media and elsewhere about what is the right price for research. And finally, I think there's been an increasing profile for independent providers and the platforms that are offering solutions to better access it and instrument pricing across the piece. So I'd say the story so far in the MIFID II is one of change and opportunities in both the asset management and research markets, and a new competitive dynamic is emerging. And I think this promises to bring not only better outcomes for consumers that MIFID II was intended to achieve, but also wider market efficiencies to the benefit of all. I will now briefly turn to one of the first 3 areas I said I would cover earlier, the impact MIFID II has for independent providers, as many of you are here today. I've often heard the question posed, why is any of this relevant to me as an independent provider? How can I induce anyone when all I supply is research? Now the answer to this lies in MIFID II's very broad interpretation of inducements and how these rules apply to asset managers. So inducements cover any third-party payments or benefits received by a firm in relation to providing a MIFID service to clients. Therefore, if an asset manager is getting something of value from a third party which relates to portfolio management services, they must demonstrate they're not being induced and treat it under these rules. Hence, valuable independent research content also falls into the same category for the portfolio manager as broker-provided coverage. So we would expect to see the buy side put in place research agreements and payment terms prior to receipt of services, regardless of the provider. But I would say on the plus side for you as independent providers, you can also benefit from the fact that asset managers can receive free trials and also issue a sponsored material as so-called minor non-monetary benefits. Pausing briefly on the issue of issuer-sponsored coverage, I would also note that if a research provider or a house broker seeks to widely disseminate such material in means such as a website, we would take the view that a simple click-through or disclaimer would be sufficient that the material is not intended for retail investors and as such avoid conflicting with our financial promotion rules. Overall, I think the FCA will take a risk-based approach towards the new rules. At this point, I'd recall that our previous concerns and focus has been on the risk of harm to consumers where an asset manager is conflicted or incurs higher costs than necessary due to obtaining research linked to trading. This is clearly more acute where a broker was rewarded for research services through the dealing commission mechanism. On that basis, I would say that the receipt of independent research, by its nature, poses less risk. And we will also take a pragmatic approach. So I would assure you as independent providers you can still pitch for business outside of a trial period or an existing research agreement. You can still offer a sample of research material or presentations to demonstrate your analyst capabilities, such as at events like today's. Such reasonable means of showcasing your services are not prevented, and the buy side should be open to accepting them. This is provided, of course, that it doesn't become a systematic provision of services without payment. I would say that the emergence of new platforms hosting a wide variety of third-party research is hugely encouraging and promotes the visibility of independent providers. This speaks directly to the type of transparency and competition MIFID II aims to encourage, and that all of us want to see and can benefit from. If a portfolio manager does buy independent material through such a platform, I would also clarify that this does not prevent a trial period directly with the underlying provider within a 12-month period. So I'd return to my theme of opportunity at this point. The MIFID II inducement rules create a platform and an imperative for portfolio managers to procure the best value for research services that are free from conflicts of interest. And this puts independent providers in a good position to press their case as an integral resource for asset managers. And the FCA will seek to supervise the rules in a way that does not inhibit this opportunity for you. My second main topic I'll briefly discuss is that of pricing. I'm aware that pricing is a sensitive one for you as independent providers. After all, this is your livelihood and your sole or predominant source of income. It's not necessarily the case for other firms. So what are our expectations in this area based on MIFID II? Well, as a starting point, brokers are clearly required to price research or other services separately from execution activities, and the price of the former should not be influenced by or conditional on execution payments, and vice versa. It also places an onus on asset managers to consider whether accepting certain pricing levels could still be deemed as an inducement, and may call into question whether their research procurement decision is really divorced from their trading relationship. In other words, large investment banks must price research and cannot offer unduly favourable terms or offer freebies to high-value trading clients, as an example. If an investment firm decides to price research substantially below cost, effectively at peppercorn levels, this would indicate a potential breach of the inducement rules. Having said that, I think we're still very much in a period of price discovery. We've all seen the media reports last year citing a rapid reduction in prices, initially from rockstar levels to bargain basement pricing. This is mainly focused on access to written content, however. Behind the headlines, we've seen most firms are applying higher prices for access to analysts or more bespoke services, whether that's per contact or on a tiered basis. And our view is that these may be reasonable commercial models. It may reflect the market value of what different services are worth and what people are willing to pay for them. Of more concern to us as a regulator would be the so-called all-you-can-eat research models at low prices, which include more exclusive services. These may be pitched well below the cost of production, and they may also mean that the provider is effectively allocating those scarce resources selectively, such as analyst access, to the higher value client. So the FCA will take a closer look at models which appear to be outliers and which raise both inducements risks and competition concerns. Realistically, however, I would say there will always remain some degree of cross-subsidy in multi-service firms, and we would expect pricing models to differ in a competitive environment. So as such, we are not necessarily concerned by the early variance in pricing per se, and we will consider models on a case-by-case basis. As independent firms, I would say that you could continue to play to your strengths by marketing your objectivity, specialisation, and depth of coverage. The FCA fully supports a competitive, transparent research market that is consistent with the inducements framework. To this end, we will continue to monitor the evolution in pricing and compliance with the rules as MIFID II beds in. And overall, the quality of research should win out in a price market that is not influenced by trading. And that's again an opportunity created by MIFID II. The third and final area I'll cover today is the subject of corporate access, which has surprisingly been a popular topic since the 3rd of January for the FCA. I I should start by saying corporate access is not research as far as we're concerned, and therefore cannot be paid for with client money through an RPA, for example. We'd also view the MIFID II framework as requiring brokers offering corporate access to price that separately to both research or execution services. And I think we'd all agree that corporate access, where a third party facilitates access to an issuer's management or a field trip, can be a valuable benefit. And this means that asset managers must ensure they are being compliant with the inducement rules if they accept meetings arranged by a third party. And this would likely involve the manager paying a reasonable commercial basis from its own resources for those meetings, which an ESMA Q&A has set out. However, if an asset manager decides to contact and directly meet an issuer on its own without any intermediation, we would not consider that a third-party benefit and doesn't require any form of payment. I would also say that for corporate access, we'll take a risk-based approach, which I referred to earlier. So we'd likely pay more attention where a broker provides corporate access than, say, an independent third party. I think we'd also apply more scrutiny where the event itself is more exclusive in nature, and also where it's clearly offered to the asset manager as a service as opposed to the issuer. So for one-to-one meetings, investor field trips, or reverse roadshows, where they're arranged by the broker on behalf of an asset manager, we would expect both the broker to price that service and for the asset manager to pay for it in return. By contrast, if a house broker is acting for a smaller issuer, is seeking potential investors on their behalf, then such meetings are likely to pose less concern. Indeed, ESMA's Q&A has said that a broker-organised roadshow for an issuer as part of a capital raising event, which is open to a wide range of possible investors, can be considered as a minor non-monetary benefit for the buy side. In our view, the same logic would apply if an asset manager receives broker analyst presentations during an issuance process, or attends a pre-deal meeting where an analyst is present with the issuer to support the price formation discussion in advance of a deal. I'd say finally, with regard to conferences, which in some cases may contain an element of corporate access in the form of issuer attendance, we would view the upfront price for such events as effectively reflecting a commercial rate of payment. So we would not generally expect the buy-side firms to try and ascribe further value to networking opportunities or material received within a conference. Overall, we believe that both buy-side and sell-side firms usually understand the nature of any given meeting or event, and so whether it's appropriate to consider pricing and payment for such services. In all cases, firms should, however, ensure adequate internal processes to assess and record the provision, receipt and payment, where relevant, of corporate access services. And this will enable them to show that you've acted consistently with the inducement rules. That concludes the three main areas that I look to focus on today. So what MIFID II means for you as research providers, the issue of pricing and corporate access. MIFID II is obviously still in the very early stages, but the initial signs are that it's driving profound and positive change in behaviour across the market. I'm optimistic that this will result in better consumer outcomes. I'm also optimistic that the UK's independent research sector and those third-party providers and solutions, many of you represented here today, will be well placed to take advantage of that opportunity. This includes offering great research and priced coverage, and also offering the platforms that make that access easier and that pricing more transparent. Going forward over the next 12 months, the FCA's focus will be to ensure that MIFID II is successfully embedded in practice. To that extent, I encourage all of you here to continue to promote an asset management sector that's more efficient in controlling costs and seeking the best quality research that will support you in making the best investment decisions for your clients, and foster a dynamic, less conflicted and more transparent research market in the UK that will best serve the needs of asset managers. This should also ultimately benefit all of the portfolios managed by UK firms on behalf of investors like you and me. One final comment I would make is that these EU reforms seem set to spark a global debate about existing practices, as shown by the US SEC announcement in October last year. In my view, this gives the UK market a further opportunity to be at the forefront of change and to demonstrate best practices on an international stage. I think this can only be a positive for UK asset managers, research providers, and platforms as we compete for international money flows. On that note, I'll conclude these remarks, and I welcome any questions.
Come up and see if I can encourage some questions for you. Oh, lovely. We've got, if we can get the mic, we have got 2 mics. We've got certainly 2 questions on this row here. Anybody after that? I can get positioned. Lovely. Sir, you go first.
Hi. I'd like to ask a question about how you view the value determination that fund managers have to make, since the value of research is very much tied to the assets deployed on the back of that research. And therefore, if you have a piece of research that sell side or an independent researcher values at X, but they sell that to, say, BlackRock compared to a small boutique fund manager, and they want to sell it at the same price, there are obviously conflicts. They're likely to do a lot more business with BlackRock. There's much less leverage from the small asset manager to pay for that or to justify paying for it. So they may be frozen out of the market from from a competitive point of view.
I mean, I think the SCA is not necessarily going to dictate the right way to value or price research. I think a lot of the platforms available give a lot more access at different levels, i.e. individual reports or service levels, and could also perhaps offer flexible pricing based on the size or scale of the asset manager, how many contact points they need, how that research might be used. So I think there is enough flexibility there potentially around pricing and valuation approaches, provided that we see a sort of justification in the background to how that process is operated. I think we'd be relatively comfortable with a variety of approaches. So in our view, I think we see there'll still be access to research and lots of flexibility there for firms.
We want a second question there, and then a third question over to the right. Oh, and then if we could have the microphone to the chat too, there. Lovely, sir.
So actually the question I was going to ask was the one the gentleman on the right has already asked. So I'd asked one question, but I have a separate question which I don't know whether you'll be able to comment on, but I'd be grateful if you can. Clearly at the moment Europe is doing its thing and the rest of the world isn't necessarily doing its thing, i.e. not necessarily following when MIFID II has started. Have you any information that can give us some guidance as to what the other regulators, particularly across the pond, may be thinking at this point, or is this outside something you can comment on?
It's probably not something I can comment on, but I think it was obviously a significant move by the SEC to announce the release in October last year and setting a period of 30 months, I think it was. I think clearly is intended to give them space to have that debate on the US side. So I think there is a momentum behind having that discussion about whether a MIFID II-like approach is potentially a future global model. But obviously, I can't comment on the SEC's sort of inner workings or thoughts.
Thank you.
Lovely. Chap on the right-hand side, thank you.
My question is about if you're dealing with brokers who actually are not within the MIFID regulation, and in those particular markets, the regulator actually sets the price for execution only. Like they set a band which brokers can use. So if you're doing that and you're actually paying the lowest rate that the regulator has set for execution, and this broker actually publishes research and distributes it free to everyone, including retail or buy-side firms outside MIFID. And this research is also available on Bloomberg or other research platforms. If you are an asset manager, you are within MIFID, how do you deal with that? Can you access that research for free because it's available for everyone else, and you're already paying the lowest execution-only rate set by the regulator in that particular market? And the broker doesn't have a policy of pricing research. They don't have any pricing on their research. So how do you deal with that?
Okay, lovely. And if we could give the microphone to that gentleman back.
Sure. I mean, I think this is one of the tensions created by MIFID II. I think there are probably two different scenarios. I think where potentially brokers refuse to unbundle and you're potentially paying a rate that may reflect some form of research, then I think there's still an obligation on the buy-side firm to seek to value what they receive and see that the bundled rate, if you like, would be justified. And I think, the European Commission's Q&A is helpful in that respect, in that it indicates you could still talk to the broker and seek to ascribe some value to those services, even if they won't offer, say, an invoiced pricing or separate pricing. I think, in the event where you're effectively paying an execution-only rate already, and that material is freely available, I think, as in the UK, I think we would see public information, public research that's not constrained, could be seen as a minor non-monetary benefit. So that might offer you some flexibility if it's a scenario where you're at execution-only rates already, if that's helpful.
Yeah, I know we've got a question there. And if we could get the microphone to that gentleman there. Anyone else after that? And then we'll do this one. And that one. Lovely. Okay. So we'll let's take a couple together, because I'm aware that we're running out of time. So Sarah, if you'd go, and then the chap a couple of rows behind. We'll take those two together.
Thank you. You talk very much about the institutional asset management market, but as representing the private client, the retail investment market, we're now paying for research considerably more than we ever did before, and getting less of it. Now, yes, we're refining the quality of what we've got, but was this ever an intended consequence?
Right, hold that thought, and we'll take that the second question at the same time, just so I can squeeze as many in as possible. So.
Sorry if this is a very basic question, but for people in the room who are providing independent research, I'm not clear what the inducement for the fund manager is. So let's say I want to set up a new independent research provider. I've been a fund manager in the past, maybe. I want to write some research. It might take me a year, it might take me 2 years to develop a relationship with a fund manager, particularly the larger fund managers. I understand the point about being able to give presentations or one-off pieces of research, but that's not practically commercial. So, and if I've got no broking relationship, so it's impossible for me to influence the dealing or the execution of that fund manager, how could I possibly be inducing the fund manager?
Okay, so how could that be inducing unintended consequences?
I'll take the second question first. I think, MIFID II doesn't strictly require an inducement to automatically have to have some, impact on where you trade, etc. It generally talks about any third-party, benefit or monetary payment that is related to the portfolio management service they're giving. So, although it seems slightly perverse in a common English sense, I mean, they're the rules we kind of work with.
Sorry, I understand that.
Yes.
How do we deal with that? So, if I'm an independent one-man band, for example, you might want my research, or I'm still trying to persuade you. Can I just say, okay, well, I'll give it to you for £500 this month, £1,000 next month. Our real value is £50,000 a year, but over the next 2 years, let's work up to that. Or I'll, it's basically we're creating an inducement scenario, so I think we all understand that. But the inducement I'm talking about is the inducement to trade. What's the downside for the fund manager's client? I don't understand that at all.
Well, I think you probably partly answered your own question. I think there's flexibility around trial periods. There's still the ability to go and show your what you can do. I think there's nothing to stop shorter term pricing arrangements that then develop into a fuller relationship and a fuller pricing over time. I think none of that is kind of set in stone by the regulation. So I think there is there is some flexibility there, and also obviously all of the platforms that are emerging to allow you to potentially get visibility through those means, if you're a one-man band and need some marketing from somewhere else, are also sort of positive developments. So, I think we're reasonably optimistic that it still allows smaller firms to operate. On the research for wealth managers or, if you like, retail platforms, I mean, it's not something that we've heard much about. I think the reforms obviously do impact you. I guess we'd be interested to hear about that. I think from our point of view, there should still be, again, flexibility around pricing and negotiations that mean potentially if you're a retail platform and you want that material to give directly to your clients, that you can try and negotiate better rates. But obviously that's not something that the FCA can sort of dictate as such. But yes.
Excellent. 100%. Let's squeeze in. I can see we've got certainly down there the chap with the microphone, and then there was someone else up there, wasn't there? Yes.
Yeah,
two,
thanks.
Two rows, one. If we take all three, so we can get the microphone to this gentleman as well, we'll try and squeeze them all in, sir.
Thank you. I wonder if you could say a few words on how you're coping. And I mean that insofar as the incredible detail that you now have to pinpoint at a trade level, client level, with all the data files you're getting. And my understanding is if you extrapolate the kind of detail that you're getting, you must be getting billions in a weekly data upload. How are you coping with that? What sort of timeline do you want to be able to utilise that data?
Very interesting. And we'll go to the chap with the red tie, 3 rows behind, just for speed's sake. So,
yeah, just a quick one, really. I mean, the surprise on corporate access, I understand, because obviously that was kind of what started this latest round of everything a few years ago. But I think it's clear that the fact is the banks didn't play ball on corporate access in the way that they did. I mean, they reluctantly ended up with prices for research. But there was very much a narrative coming out of the sell side that, look, this is all bundled in. It's fine. We'll give you gold service and corporate access is included. And so that maybe created some of the recalcitrance from the buy side to split out the corporate access cost and value it separately. So at what level do you ascribe responsibility to the broker in all of this? Because obviously, I think that's one of the reasons why you might have been surprised, because they wanted to hear, they heard what they wanted to hear from the sell side.
And we'll take the very final question here.
Thank you. I was interested by your comments that an IRP can surface their research outside of a trial or a research agreement to a buy-side prospect. It's the first time I'd heard that, but perhaps not the first time you've said it. And you said that the buy-side should be open to accepting that research. I represent an IRP, and 2 months into the year, I think, of my experiences, the buy-side doesn't think that's the case. I think from my perspective, it'd be helpful. Would you have any intention of clarifying that to the buy-side, that in fact that is your view? I think that would help a lot of people in this room.
Lovely. So that one is sort of where does the buck stop sort of question, and a very caring question about how you're coping.
Yes. Well, personally, very busy, but so we are obviously getting an awful lot of transaction reporting data. So much so, I think it's caused a few issues with our systems. But I think it will give us a much richer data set, and plus public information like the best execution reports that firms will have to fill out. I think it will give us a much deeper set of data to look at, and things like execution practices will become far more transparent. In terms of a time frame for when we will start to distill that data and maybe use it more proactively in supervision, I wouldn't like to say. I mean, I think we are currently doing business planning about our supervisory priorities in the next 12 months. MIFID II implementation as a broad topic is at the top of that list, but the particular areas we look at will sort of be decided in the next couple of months. But certainly the opportunity is there to use that data. To Mike's point on corporate access, I think we tried to make clear in the last couple of months that we expect brokers to price that as a service separately from both execution and research. I said it today, I said it to the Investment Association as well, and would say it to any banks that come calling. I think we are aware that remains a potential conflict of interest and inducement risk where you have to buy the gold research package to get the corporate access, or you have to trade to get corporate access. I think we see that as part and parcel of the same issue, and MIFID II requires a sort of unbundling across all of those separate aspects to try and mitigate that risk. The final question. Yes, so I think the message I'm trying to say is that the FCA wants to be pragmatic. For a sort of full fat provision of service, we'd expect a trial period, or we'd expect pricing terms and an agreement to be in place. But I don't think that stops you going along to pitch. I don't think it stops using some sort of old samples of research to say, look, this is what I can do. I may have had a trial already, but it's 6 months later and I've improved, or I've got something new to show you. I think that's where we're going to take a sensible approach, and independence especially, as has been alluded to, the inducement risk there is clearly not so great. So it's just a sort of...
That's not the impression that the buy side has.
Yes, so I think we're also aware that, and I've heard sort of rumours that some buy-side firms are being more sort of conservative and perhaps firewalling everything. I mean, we don't necessarily think MIFID II requires quite that level of kind of blocking out of content, but obviously I can't necessarily speak for exactly what different firms are doing at the moment, and hopefully the message, as this beds in, hopefully there'll be a little bit more, flexibility there and to take a sort of risk-based approach as we would in supervision as to what they can accept.
Lovely. Well, thank you so much for taking those questions and also for your presentation. Ladies and gentlemen, please show Adam Ribblesworth your appreciation. Thank you very much. For those of us who want to continue to discuss this issue, stay in this room for the next panel, which is going to be delving deeper into MIFID II. If, on the other hand, you want to go to the other auditorium, there are three speeches, there are three keynotes there, breaking down the year of Amazon, UK healthcare risk, and defence industrial policy. So now's the time to decide. Can I ask those who are staying in this room, how's the temperature? Is anybody cold in here, or is everybody cold? I thought I saw some people looking a bit cold, particularly my fellow women. So I don't know if we'll see if we can fix that. I thought I saw some lips going a bit blue.